In this video, traders, we're going to look at what is a wide moat in companies and how to find it. Stay tuned. Hey traders, warm welcome to you. If you're a subscriber, welcome back to the channel. I appreciate your support. Okay, so what is a wide moat? From an investing perspective, a wide moat, if you think about the castles, especially England, they would have a moat around the castles, about the castle, to protect the castle. Drawbridge goes up, then of course they can fight and attack. They were often built on a hill as well. But with that moat, it gave them opportunity to defend, so that people who were soldiers or armies who were trying to attack couldn't do it. And the wider the moat, the deeper the moat, as you can imagine, harder it is to attack. So that makes perfect sense in the castle region, or the castle sector. Is there a castle sector? Maybe there should be. Maybe there should be a castle ETF. Anyway, that makes perfect sense in that scenario. Let's have a look at it in terms of companies. So wide moat, again, is the same kind of thing. It protects intruders, it protects competitors from stealing the profits. And Warren Buffett referenced wide moat. He said, listen, we want to find companies that have got that big moat, have got a moat that stops incumbents chipping away at the profitability of that company. So they're going to be there for the long term. So wide moat from a company perspective is they've got a unique edge. Okay, so they've got something that nobody else has, and so, or someone else, if they want to get it, is very, very tricky for them to do. A big barrier to entry, so perhaps they've got a big kind of head start in things, and it's going to take another company a long time to catch up to them. It protects profits, so it's something that ultimately keeps those profits protected, and is very hard for others to get on board. And if we can look at kind of some of the big examples before we move on to the checklist. Amazon, great example. You know, they're very, very efficient now. Something like 40% of all online stuff in the US is done on Amazon. They've got the supply chains in place. You know, they can afford to drill down costs, and it's very tricky for any other company to come in and produce them on a large scale. Sure, there are e-commerce businesses out there selling smaller things, but even those now are kind of finding, well, Amazon have got the leads, let me use Amazon fulfilled by Amazon, and get Amazon take a slice of the pie there, just because they can fulfill it easier, it's cheaper, they can store it. So Amazon really have a wide moat in terms of that. Then we've got something like Walmart, maybe Tesco if we're looking in the UK. This could be arguable, but the buying power and the volume these people are shifting means that there's a big wide moat. We've got even things like, think about the volume, look at Wetherspoon. Wetherspoon's a pub chain in the UK. Very, very cheap alcohol and very, very cheap food. And because they can do it at such volume, they can buy food and alcohol, specifically the alcohol, beer, that is really at the end of its use by date. It's not gone left to go before it's out of date, but because they're shifting so much of it, they can afford to buy big batches of that very, very cheaply, and then afford to sell it cheaply. So that's a big wide moat. You know, unless you've got the volume and you've already got the customers, you couldn't do that. So you couldn't offer that price. You'd have to compete with something else. So, so from a point of view of being a discounted retailer, you're going to struggle with that a new company coming in, unless it's got a lot of money and a lot of kind of time to push into that. So let's look at a checklist. They're not always easy to spot. These are kind of obvious ones. Let's look at a checklist and see what companies would have a wide moat, what we need to look for in companies to see if they've got this wide moat. So the first one is performance during weak times. If they've got a wide moat, it means that their ability to sustain any weakness in the economy is good. You know, when people aren't spending so much, a moat would indicate that, hey, you know what, people are still spending, and they've got that ability to ride out those rough times. They've got the ability to get their margin squeezed but still be profitable. Same as number two, having cash in the bank. A lot of people say, hey, you need to be giving out as dividends, you need to be returning to investors, but you know, this is the sort of thing that allows them to weather storms when things aren't so good, and that's what the wide moat does when you've got, you know, not attacking things in terms of not just others, but in terms of weather, if you like. If we look at the castle analogy again, and the economy, a castle company, the company is the castle, the economy is the weather, you can see how having a good protected environment helps them stay longer in business. Relative to performance to the others in the sector. So, you know, this is an easy one to look at. We can look at the sector, we look at others in the sector and say, well, how are they performing during all the times? If a company is, you know, still profitable, still chugging along nicely during bad times and good, and is outperforming their peers in the sector, that is a company with a wide moat. It means that the others in the sector are trying to get in, but they can't quite get the traction that this company's got. A single product dominance. If you look at Apple, for example, the iPhone, massive market for the iPhone, is dominating the smartphone market. Yes, there are other smartphones out there, but the point is for another company to come in now and take on the iPhone, it's probably very challenging for them to go from scratch. Yes, there's some bigger companies that can come in and get into that space, but they've got a good foothold there. They've got a single product that's dominating the market. And then we've got number 5, which is powerful branding. The biggest one, really, arguably, the brand. You know, a brand is something that, if you think of things like the soft drink market, like Coke and Pepsi, you know, the Coke brand is the thing they have that creates that such a wide moat. Yeah, sure, others are trying to bring in different types of colas and different things, and I'm sure the flavors, we can argue about the flavors and stuff, but ultimately it's syrup in carbonated water. The point is the branding is so strong and is so ingrained into many people's lives, and they're so involved with all the chains and pub chains and restaurants, and they've got that distribution that it's such a wide moat that many incumbents can't get over that to get the traction, to get into that market. And you know, we could argue the case that the soft drink market is declining, but that's by the by. The point is the company's got a good brand. So wide moats, guys, something that Buffett has mentioned. So for longer term investing, to keep your assets protected, something to look for. It's that big barrier, it's that big edge that stops other companies chipping away at the castle, which is the company's profitability. See you next one. Bye bye.